So we've now looked at the company's perspective in a liquidation. So when a company is liquidated, it will turn all of its assets into cash. It will pay its liabilities, including the amount owing to SARS. And that's the company's perspective. It will then pay out an amount to the shareholder. We're now looking at the shareholder's perspective. What happens to that amount that the shareholder receives? Now, the first thing I want you to be aware of is paragraph 77 of the 8th schedule. So it's the CDT section. Basically, what this section tells you is if a company is liquidated, then the shareholders are treated as if they disposed of all of their shares. In other words, you can't have shares in a company that has been liquidated because the company no longer exists. So they will be treated as if they sell it. Now, so they'll say proceeds less base cost. Now what I want you to understand is this proceeds figure over here, that will be any amount of contributed tax capital that the shareholder received from the liquidation. The base cost remains the base cost. So this is what it says. It says, a holder of shares in a company that is being wound up or liquidated or deregistered must be treated as having disposed of all of the shares held by that company, or by that holder in the company at the earlier of the date of the dissolution, or in the case of liquidation, when the liquidator declares in writing that no reasonable grounds exist to believe that the holder's share of the companies will receive any further distributions. Okay, so they're just, most important there, you treat it as if you sold it. So where a return of capital is received in respect of a share, and that return of capital accrues to the holder after these dates, that return of capital must be treated as a capital gain. So basically what they're just saying is, if you've already received all of your money, your contributed tax capital, you've done this calculation, and a year or two later, the liquidator manages to get a little bit of extra money, any extra capital CTC as you receive will be treated as a capital gain. Okay, but most important here, guys, that's not as, number 2 is not as important, paragraph 1 is important. You are treated as if you sold it. So this is still the shareholder's perspective, just summarized. So the shareholder is going to receive a distribution from the company, and that distribution can only be a dividend or contributed tax capital / return of capital. The dividend portion is a dividend, guys. You include the full amount in gross income and the full amount is exempt. Nothing has changed there. The return of capital is a different story. Okay, now I want you to pay attention. So that's what we just spoke of. If you're a share dealer and you receive a return of capital, that amount is gross income. You're treated as if you sold the shares for that amount. If you're an investor, you're also treated as if you sold it for that amount, but it's capital nature, so it becomes proceeds. So guys, I'm just going to remind you, previously when we studied shares, we saw that if a shareholder receives return of capital, they have to apply paragraph 76B. That's the section that tells you to calculate a new base cost. You do not apply that section in liquidation. Why? Because after the liquidation, there's no shares. So you can't have a base cost for shares. There's just no shares. So that's why it doesn't apply. I'm just reminding you also to please remember to consider section 9 capital C. That's a section that tells you if you are a share dealer and you've had shares for 3 years or more, then you must treat it as capital. Revise that. That's still applicable. And then I'm just making the comment here, please also consider paragraph 19, the dividend stripping section. Right, if you make a capital loss, and we'll discuss that in the upcoming slides.